Hi and welcome to the fourth edition of the weekly Insights video. Today I'm going to talk about two companies, a company in the iron ore space and a company in the travel space. Let's start with travel first. Flight Centre reported its results only a few days ago, and the results were spectacular. The company increased its profits from $139.8 million to just over $200 million. Despite this fantastic result, the share price hardly budged. And the reason that's the case is because, one, the share price had rallied in anticipation of a very good result. Two, the result was very close to the most recent analysts' estimates. And three, last year's result included a one-off item that impacted the profit by $32 million. So the jump in profit wasn't as great as what it appeared on first blush. Now, you might be surprised to know that not only is Flight Centre the travel agent on the corner of a street in your neighbourhood, but Flight Centre has 2,362 stores, and get this, in the UK, the US, Dubai, Singapore and China. As a store rollout story, this is a terrific one, and there's obviously a lot more capacity to go. Investors have long been focused on Flight Centre's exposure to Australian outbound travel, and if the Australian dollar falls or the economy goes into a recession, it would impact Flight Centre today. But in the long run, those things will impact the company less and less. In the United States, the company doubled its forecast profits, and in the UK, its profits were up 53%. And I'm using EBIT, earnings before interest and tax, as a profit figure there. Flight Centre's growth in profits hasn't only occurred in the last 12 months. In fact, since 2002, Flight Centre's profits have grown an average of 12% per annum, from $63 million in 2002 to $200 million today. And it's not only profits that are impressive, cash flow has been phenomenal as well. In fact, Flight Centre only asked for another $1 million from its shareholders over the last 12 months. And yet, cash at bank has increased by $111 million and debt has fallen by $63 million. This strong improvement in the company's cash position is a result of a very strong improvement in cash flow from operations. Cash flow from operations have grown from $154 million to $341 million. And after spending on new businesses and on acquisitions and investing in itself, it was still left with free cash flow of $130 million. So it's not surprising that dividends continue to increase. We own Flight Centre in the Montgomery Private Fund, and we still believe that the long-term prospects for this business remain bright. The next company that I want to talk to you about very briefly are the mining companies, the big mining companies, BHP, Rio and Fortescue Metals Group. Now, when you look at consensus earnings and analyst estimates, what you're going to see is that estimated intrinsic value for these businesses appears to be rising. But you need to dig a little bit deeper. And what you find is that when it comes to consensus analyst estimates, there's no consensus at all. In fact, in the case of Fortescue Metals Group for 2014, the range of estimates is for earnings per share of 34 cents to $1.60. That is too uncertain for us to rely on any estimates of intrinsic value. And we believe the iron ore price, which is now below $100 a tonne, remember all those experts who said it wouldn't fall below $100 a tonne, it's now below that. We think it could fall a lot further. If that's the case, those estimates will be all downgraded with implications for the share prices of our big miners. Look forward to seeing you again next week.